In Chapter 3, we discuss money management strategies. In this chapter, we're going to look at a variety of different types of things. For instance, where to keep your financial documents, personal balance sheet, creating a personal balance sheet, cash flow statements, saving strategies, and then also creating a budget. Money management and money management strategies, really when it comes down to it, is how can we get the most bang for our buck? How do we get the most money for our money or the most value for our dollar? One of the first things that we need to consider is the organization of our financial documents and or creating these financial documents. Some examples of things that we're discussing here are bank statements, paychecks, car titles, birth certificates, tax forms, tax returns, anything along those lines, anything that we may need for deduction purposes on our taxes later on. And in terms of that organization, where are we going to place these documents so that they're safe, but also we reduce the risk of identity theft? Where do we want to keep these documents that we were talking about? For instance, the tax forms, the W-2s, the W-4s, things that may have our social security number, bank number, routing number, things like that of value. One place that we could store these are just at home. Maybe it's in a filing cabinet or in some file folders that we use in order to help organize ourselves. We don't want to have these things just laying out and about. We want to have them in a nice, safe place or a fairly safe place because they are hard to replace. For instance, a birth certificate, for example. If I wanted a hard copy of my birth certificate, I would have to travel to Belleville, Illinois, where I'm originally from, in order to get access from that courthouse to get a birth certificate. So I have two copies on hand that I keep with, not necessarily with me, but I keep them at home in a safe, in a fire-safe box. If that's not good enough and we want to take another step up, we can get what's called a safe deposit box. These are located at banks or financial institutions. They're usually stored in the vault itself. And for storage space, just if you were to rent a storage locker or something else, they're going to charge us usually either a monthly fee, a 6-month fee, or potentially a yearly fee based on the size of the box. The bigger the box, the more the cost. I mean, that varies from bank to bank. Now, this is going to be an extremely safe location to store, for instance, passports, stock certificates, contracts, pretty much valuable jewelry. Anything that we want to keep, especially in the area of for instance, pieces of paper that have importance to them. And the reason why we may want to put these things in a safe deposit box is, yes, they can be safe at home, but if there's ever a theft or a break-in at home, if there's ever a fire or flood or water damage or a tornado or anything else like that, one of the safest locations that you could be in would be in a bank vault, and that's why we want to store those documents there. Now, another place that a lot of people store, especially now in the digital age, is they store a lot of documents on their home computer. Now, this can be good and bad. One, that's nice because we have everything potentially in one location and or have access to it in one location. The downfall is, especially if you're dealing with technology, is what happens if, for instance, your computer crashes. You're working and all of a sudden lightning strikes. If you're working, for instance, in the middle of a lightning storm, not outside obviously, but inside. That could fry your computer. Maybe you're at Starbucks with a large coffee and that coffee spills on your laptop. If that's the case, it may very well fry the laptop or fry the hard drive. You're going to lose all those documents that you once had saved. Now, you could get an external hard drive and save those things other locations as well. I understand that. Just options to think about when saving documents on a home computer. A document that you should always consider is what's called a personal balance sheet. And what this is it is a net worth statement. So we're looking at your assets, everything that you have of value, and we're going to subtract that against your liabilities, anything that you owe. This could be something, for instance, owing $5 to Timmy for lunch money, to a car loan, to a home loan, or anything else where you owe someone else money. Credit card debt is a great example of a liability. Assets could be anything from cash to homes to cars to baseball cards, anything of value is considered an asset as long as it can be turned into cash. Now, you may have mentioned or noticed right there when I discussed things of assets but also liabilities, I mentioned home and cars in both. If I owe anything on those cars still or that home, that would be considered the loan part of that is considered the liability. On the other side of it, the asset itself, the home or the car, that's the asset. So we may see things in two locations on our personal balance sheet. Okay? And in order to figure out what our net worth is, we have to add up all of our assets and subtract that. Now, the number that we're left with is what's called our net worth. We can have a positive net worth, which means we're in a good position financially. We can also have a negative net worth. Now, depending on how far negative that is usually going to give us a nice glimpse in terms of how we're doing financially. Need to know fact, net worth equals assets minus liabilities. You'll see that on your Chapter 3 test, your midterm, and also your final. Need to know equation. Now, talking about creating a personal balance sheet, step one is we've got to figure out your assets. Now, on your net worth project that I've assigned this week, you'll notice that you're going to actually do this. This is situation 9 in your net worth project. And as what you're going to do is in Microsoft Excel, you're going to list all of the assets that you were to have maybe in your room or if you have a car, anything that if you were to move tomorrow that you would consider yours, okay, your personal possessions, cash, bank accounts, stocks, bonds. Maybe, for instance, your grandparents have given you bonds for the last couple of years for your birthday. That would be an example of an asset. So you're going to list all of those things and with appropriate value in terms of what that is. Then you're going to list all of your liabilities. And then in Excel, you'll subtract your assets minus your liabilities. There's that equation again, need to know equation. And then what you're left with is either a positive net worth or a negative net worth. The majority of you have either little to no liabilities, at least in your current state. And that is a great position to be in. This may be one of the only times in your life that you can say, I have a zero liability state or zero debt. Something else to consider in terms of wealth, one is our liquid asset. It's important for us to understand with that liquid asset, that's how fast I can change that asset into cash. For instance, a checking account is a great example of a liquid asset. I can just simply go to the bank and withdraw money or put a card in an ATM and have that thing of value, that asset, have cash in hand extremely quick. Real estate. Real estate is a great investment. It's a great asset. However, it is not a very liquid asset because you're going to have to put your house on the market. You're going to have people come and look at it, make you an offer, do some negotiations, then go through the process of about a month or two before you can ever get your money. That's if your house actually sells. Other personal possessions. Right now, you guys would be amazed with the value of money that's currently in your closet. If you think of every item of clothing, shoes, sports memorabilia, sports equipment, bedroom furniture, accessories, jewelry, all of those things added up together should give you an idea of assets that you have. But if you just think of if, for instance, there were a fire and you lost every item of clothing that you have, how much would it cost to replace every item in there? And it's kind of an astronomical number if you think about it. And then also we have finally the investment assets. This is if, for instance, I've created a Roth IRA or I've dabbling. Step 2 in the personal balance sheet or creating a personal balance sheet or net worth statement is going to be determine your liabilities. Liabilities are anything that you owe. There are two different types. We have what's called a current liability and then also a long-term liability. A current liability is a short-term debt that can be paid within a 1 year or is planning on being paid in 1 year. For instance, your taxes every single year. You're required to pay taxes in the United States once a year based on your income, any jobs or anything else like that. And so, for instance, that is a current liability. Anything that's going to be paid, for instance, for monthly services or anything else along those lines. Now, a long-term liability, on the other hand, this is something that's going to take at least a year, if not longer. For instance, maybe you have a car loan and you take out a 5-year car loan. If that's the case, that's going to be considered a long-term liability because it's going to take longer than one single year, which takes us to mortgage loans. You may or may not know the two most popular mortgage loans in the United States today is a 15-year term and then also a 30-year term, which means that you take out a loan with the agreement of either paying it back in 15 years or 30 years. We'll talk a lot more about that once we get to the housing chapter. This is our last personal balance sheet slide. Step 3, calculate your net worth. So we're going to look at those assets, we're going to subtract our liabilities, and that's going to give us our overall net worth. Now we want to avoid a situation that's called insolvency. Insolvency is a financial state where liabilities are greater than our assets, which means we're upside down financially. We've got more money going out than we have coming in, which is one of our goals of this class, is to make sure that we have more money coming in than we have going out. Step 4 is we're going to evaluate that financial situation that you're currently in. Are we in insolvency? If so, how do we get out so that way we end up with that positive net worth? Next is our cash flow statement. And as what a cash flow statement does or looks at is exactly what the name states. We're looking at cash flow, money that's coming in to our wallet or into our pocket, and then also going out. And that could, for instance, be bank accounts or anything else, but we're thinking of, for instance, looking at a paycheck. And I know that I'm going to have some gas expenses, so that's going to be money outflow. Anything coming into, for instance, an individual or a bank account is going to be money inflow, where I'm paying someone or giving money to someone else. That's what's going to be considered money outflow or cash outflow. Now, in terms of creating this statement, step 1 is we're going to have to record what our income is. How much money do we have coming in? Now, you have to understand the difference between net pay and gross pay in terms of cash flow statement. What we're doing is we're looking at net pay in terms of what is the overall money that we're going to have in our pocket at the end of this paycheck. Not our gross in terms of what our overall payment is, but what we're actually taking home after taxes, investments, anything else that we have coming out of our paycheck. Now, once we've paid everything off, we have what's called a discretionary income. Discretionary income is a lot of times what people will consider fun money. So after we've paid ourselves first, which is the cardinal rule of personal finance, we've paid any bills or anything else, other essentials, for instance, food, clothing, shelter, transportation, medication, medical, anything along those lines. I've paid off any payments or anything else. This is money that's left over. I could either save this, I could have a little fun, I could take a trip, whatever the case is. That's the discretionary income, is what's called or considered the fun money. But before we look at the fun money, we have to make sure that everything else is taken care of. All too often, especially in the United States, people look at general income as discretionary income, not taking care of business, paying ourselves first, making sure our debts are paid off before we have the fun. I'm a big advocate of fun. I think it's a great thing. I like nice things. You should like nice things, but you have to be able to pay for them. Next in our cash flow statement is step 2. We have to record our actual expenses. So money that we have going out. Maybe it's a cell phone bill, maybe it's car insurance, maybe it's gasoline, whatever the case is. We've got 2 major expenses that we need to discuss. We have what's called a fixed, and we also have what's called a variable. A fixed expense is what this is this is going to be the same every single month. So a lot of times it's going to be like a house payment or a rent payment. If you're on, for instance, a budget billing plan of some sort where it's the same every single month. Now,